From New York for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, Powell leaves the door open for future rate hikes. The Fed chair also speaks to the neutral rate as R-star stands in flux. And with yields riding higher, the 5-year real yields climbed to the highest level since 2008. We're going to begin with the big issue, though, how investors are trading on the idea of higher for longer.
It is the Fed's job to bring inflation down to our 2% goal. 2% is and will remain our inflation target. The process still has a long way to go, even with the more favorable recent readings. GDP growth has come in above expectations. Readings on consumer spending have been especially robust. We expect this labor market rebalancing to continue. 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth. The effects of monetary restraint should show through more fully over time. Sustained progress is needed, and restrictive monetary policy is called for. On a 12-month basis, core goods inflation remains well above its pre-pandemic level. We are attentive to signs that the economy may not be cooling as expected. Risk management considerations are critical. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive. We will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant. We will keep at it until the job is done.
Joining us now is PGIM's Michael Collins and Oaktree's Danielle. Poli, thank you both for joining us on such a pivotal day for Fed Chair Powell. He really did leave the door open. You are seeing the front end of the curve up about to 5.05 on the 2-year. When you think about what was said today over in Jackson Hole, does it change anything about the way you're thinking about putting money in the bond market? Michael, let's start with you.
Yeah, I mean, the market's reaction has been pretty muted for sure. If anything, the markets continue to shift towards this view that that funds rate, whether it goes up any more from here or not, but the important thing is how long is it going to remain with a 5 handle? And the markets are definitely shifting the curve, the intermediate part of the curve, closer and closer to that funds rate. That's been our view, that the curve was too inverted, the front end was too inverted. So the markets are starting to price in a higher funds rate for longer, and that's certainly a very possible scenario.
In conjunction with a higher funds rate for longer, he did hint at the uncertainty around R-star, probably not to the degree the market wanted. But Danielle, if you think about longer term inflation and interest rate targets, do you think that there needs to be movement on that front?
Well, you know, Sonali, I wasn't surprised either by his comments. I think it confirmed to us a higher for longer environment that we've thought that we've been in for some time. Our chairman at Oaktree, Howard Marks, penned about this sea change in markets at the end of last year, really noting that persistently high inflation would require more restrictive monetary policy and thus shift this era of cheap money, which has fueled stocks and other equities, and really create, I think, an interesting and compelling opportunity for credit markets where rates are higher, and that does have implications, but it can benefit investors who can now get decent yield across the curve.
Danielle, where are you comfortable putting that money to work? Because on one hand, there are opportunities, but on the other hand, higher rates could signal more distress in terms of the more risky parts of the market.
Now, that's absolutely right. Within our global credit portfolios, where we can be tactical and nimble and allocate across different investment categories, we have been favoring loans. Given their floating rate nature and the increase in base rates, the yield one can get is quite attractive. When diversifying across those asset classes, it's a double-digit yield. But you have to be a credit picker, and you have to avoid the landmines, because as you point out, income is a double-edged sword, and we are seeing stress in some borrowers who are having to make significantly higher interest payments. And we do expect that stress in the market will pick up, defaults will be higher, but it is such a large market that if we can avoid those landmines, there should be good opportunities.
Michael, there's another issue that had come up today, too, and that is the divergence in rates, the divergence in monetary policy as you see it across the world. What does that mean for the value of a U.S. Treasury?
You know, U.S. Treasuries look attractive to us by almost all measures, right? I mean, versus other bond markets, versus even real risk-free rates like SOFR, or other, risk-free rates that aren't affected by the huge amount of Treasury supply. So when you strip that out, you're getting paid a huge premium to actually own long-term Treasury notes in the U.S. versus other risk-free assets. So I think there's value there. Also, if you're managing a global bond portfolio, there's a lot of different currents, as you mentioned, happening across different central banks, different economies, different bond markets, different yield curve shapes. So there are ample opportunities to take advantage of that. For example, we might be, short Japanese government bonds, thinking that 10-year JGB yield of 65 basis points might have some upward pressure given these higher rates around the world, and maybe, long other interest rates.
Well, speaking of other interest rates around the world, there's a lot of conversation this week about the pricing when it comes to European bond markets, potentially overvaluation or overbought gilts, overbought euro even. Do you have a view on whether that is the case or not?
Yeah, I think interest rates in the developed world generally look really high. You're seeing growth, obviously, in China really start to crumble. That will affect Europe. And in fact, it is affecting Europe. There tends to be a much more immediate impact on Europe vis-a-vis the U.S., where we tend to be a little more internally focused. So if the view is that growth in a lot of places are going to continue to lag and come down, whether or not inflation really follows. I think there are opportunities in some of those other bond markets where their central banks, whether it's the European Central Bank or the Bank of England, are probably looking to raise rates, one or two more times.
Danielle, when you think about what was said today, everything today that's happening in Jackson Hole, the reality is there's a ton of economic data ahead. What are you looking at in particular, and how are you factoring any potential of future inflation shocks?
We are focused still on inflation. I think we've seen commodity prices come down rapidly, but they could surprise to the upside in the future. We're also focused on shelter, given what a large percentage of core that makes up. Generally, outside of inflation, we're watching the labor market. It's remained incredibly tight with significant wage growth, and we do think that needs to cool off, and we will be getting increasing data. And today, Powell did really express that his views and monetary policy will continue to be data dependent, but that there will be generally tighter financial conditions in the market, which then has implications, as Mike was saying, for all types of different credit asset classes. We've talked a lot about the public markets, but also the private credit markets in particular. Tighter financial conditions, less lending from banks. This should create opportunity for credit investors.
Well, how much competition does that set up for credit investors? If you look to the private markets, Danielle, you have asset managers pitching anywhere from 8% to 12% returns. When you look to private markets, they give you that trade-off in liquidity. Do you buy that story over what is publicly traded, or do you find that the public markets offer compelling opportunities too?
I think the public markets offer compelling opportunities too. And if you can have a blend of both in your portfolio, all the better. I think that you've seen issuance generally down in the public markets, and some of that is being absorbed by the private markets, as there are managers that don't have legacy portfolio issues, can write and speak for large checks, and really step in where the banks have pulled back. And that's not just the case for corporate loans as well. Real estate in particular, with commercial lending, banks have provided over 50% of the financing, and there's a lot of maturities coming due over the next years that will need to be refinanced. So we do see really attractive private opportunities.
Now, I want to point to a conversation earlier today with Steve Whiting of Citigroup, who weighed in on the bond moves in short positioning in particular. Take a listen.
One of the things you can see right now are record high levels of short positions in futures and 10-year notes and 2-year notes. It's a lot like where we were in the equity market at the beginning of the year. We see a lot of shorting of bonds right now.
Michael, I want you to weigh in here on some of the futures positioning here and how investors are set up for the future about potential future sell-offs. Do you think that is the correct direction of travel?
I think that's a great contrarian indicator, Sonali. The positioning tends to go from student body left to student body right. I mean, just a few months ago, the markets were pricing in a pretty high probability of recession, and everybody was long duration. At that time, in our strategies, we actually got a little bit short, thinking, wow, there are way too many Fed rate cuts priced in way too soon. And as the curve has backed up a lot, and now we're moving back toward what is likely the higher end of the range on interest rates, everybody's now pricing in this soft landing scenario, this really benign scenario, both in rates and in credit. Right. So I think the idea is to fade both of those, to go the other way, start adding duration in here. We've certainly been covering our short duration position, much more constructive on rates at these levels. And to Danielle's point, a little more nervous on credit given the rally in spreads.
Danielle, I'd love for you to double down on some of the nervousness, because if there are sectors or types of credit you're avoiding, what would you sell or avoid touching right now?
Well, it's hard to paint things with a broad brushstroke. I think what you need to do is you need to look at some of the capital structures that were put in place back in 2018 through 2021, where in particular, private equity sponsors weren't considering this drastic rise in base rates that we've seen and having to refinance into this type of a market. And so some of those companies and those vintages are going to be the most vulnerable across all different types of sectors. Generally, what we have seen this earnings period is some resilience in the consumer. Consumer sectors are doing better than many would have thought, and there may be reasons for that, like excess savings not having run out, and many of these companies having time to prepare their businesses for a recessionary environment. So as always, taking an individual credit approach we think is better than looking kind of top down across sectors.
Danielle, if you think about this idea of bonds versus loans at this point, given the attractiveness of floating rate, do you stick to that trade, or do you start to rotate a bit now?
I love the yield pickup that loans provide today, but I am mindful looking top down at the two markets that the loan quality is a lesser quality market. I mean, the high yield market is actually has a double B percentage that's at a 10-year high. And if you think about what we went through during the COVID period, where you had defaults from investment grade, as well as some of the worst CCC cohort defaulting from the market, it's just a higher quality market, and one which many used kind of the open window to extend their liquidity. Whereas in loan land, now that those interest payments are coming up and ratings are lower, it's a generally lower quality market. You saw loan-only capital structures put in place in some of those vintages that I mentioned. But if you can pick the right loans, it is a $1.3 trillion market. And if there are increases in defaults, that still leaves so much of the market that will repay that high income that we don't think it can be ignored in actively managed portfolios today.
Recalibrating our bets across the board on a big day. Michael Collins and Danielle Poli, thank you both so much for your time. Up next, we have the auction block. We're going to focus on the banks as Charles Schwab sells fresh debt after revealing plans to cut costs. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg's Real Yield. It's time now for the auction block. It was a quiet week here in the United States, but it was quite active in Europe, and the summer drought has come to an end. Financials helped to drive sales in the primary market past 30 billion euros. The one notable sale in the U.S. was tied to a bank. Charles Schwab sold $2.3 billion of senior unsecured notes in a two-part deal. The move comes the same week it announced job cuts and office closures. And sticking with the financials, that sector around the globe has sold $2 trillion worth of bonds in a record time this year. Sales of euro-denominated securities are up more than 50% from the same period last year, making up the largest share globally. Now we're going to get back to Powell because Mohamed Al-Arian of Bloomberg Opinion and Queen's College Cambridge weighed in on the Fed's path forward.
If the right inflation target is 2% and they want to get there in a credible period of time, then we are not sufficiently restrictive. if the right inflation target, as you've heard many people say, including Adam Posen today, is above 2%, given all the structural changes, and the way we're going to get there is not by announcing the new target, but by following a shadow target, and then once we see it stable, adopting it. I think that's the most likely outcome, by the way. Then we are sufficiently restrictive.
Brian Smedly of Cynosure joins us now. Brian, if you take a look at what had been said today by Fed Chair Powell, was there anything surprising? He had left the door open for future interest rate hikes. You still have a market expecting cuts into next year.
Yeah, that's right. I don't think Chair Powell really broke any new ground today. He echoed a lot of the themes that he emphasized in the press conference and that were, again, in the FOMC minutes from the July meeting. But I think he really put a marker down to indicate that the Fed is not considering revising up its inflation target, as Mohammed spoke about. They're focused on 2%. They clearly feel like the job is not done. There's more work to do to loosen up the labor market for the Fed to feel confident that inflation can be brought back down to 2% and sustained at that level going forward.
Well, let's talk more about that target, because there's been a lot of conversation this week about R-star, and he voiced the uncertainty around it. However, to your point, he did not go so far as to say that it should be revised. Should it be?
Yeah, well, I think long-term R-star probably is higher than the 0.5% that's indicated in the longer run dot in the SEP. So I think that probably is too low. That estimate came down over the course of the post-GFC period. And has stayed at 2.5% in nominal terms, half a percentage point in real terms. I think that's the evidence suggests that it has risen. As Chair Powell indicated, the labor market is having a greater impact on inflation today, a tight labor market, than we saw before the pandemic, and that suggests that the Fed's longer run unemployment rate estimate may be too low, and that R-star may also be too low.
How much variability does that mean for longer term interest rates? And what does this mean about the more permanent repricing of rates? Yeah, well, it certainly speaks to the higher for longer theme that your previous guests were discussing. And I think it suggests that the Fed is going to have they're going to have a long waiting period when they finally do finish hiking to wait and see the data evolve and try to get more clarity on what R-star is. But one of the challenges that the Fed has had is that the forward guidance on the longer run neutral rate, I would suggest, has been working at cross purposes with what they're trying to do on short-term interest rates on the balance sheet, because it's contributed to a significant inversion of the yield curve, because their guidance is contributing to that anchoring of long-term inflation expectations. Yeah, there's a lot of conversation around that lagged effect and the tightening that we might still see, but explain what the balance sheet reduction means on top of the interest rate hikes itself. Sure. Well, without a doubt, the Fed's addition of duration supply and convexity through the runoff of the portfolio is contributing to the rise in long-term rates. We just heard from the Treasury at the beginning of August in the refunding statement that they are beginning the process of several quarters of increasing coupon supply. That's going to add to what the Fed is doing, and on top of that, we've got a significant budget deficit. So, without a doubt, the market is going to be struggling to digest supply, which is why I think from a yield curve positioning standpoint, we're going to continue to seesaw between, bear flattening episodes like we've seen today and steepening episodes like we saw earlier in the month as the market has to digest more supply. I want to bring out even another view brought forward by PIMCO's Tiffany Wilding this week, because she wrote in a note to clients this week that recent data would suggest the consumer and the economy could remain surprisingly resilient in the face of higher interest rates, to your point on that labor market. But sure, it means that it's not unthinkable to envision the Fed not only staying on hold, but announcing a further rate hike next year. Do you buy that view? I think it's possible. I think there's a good chance that in the first quarter the Fed might decide that more work needs to be done. That wouldn't be my base case at this point. I think it's most likely that they deliver one, maybe two more hikes before the end of this year. But I think it's too early to say what the first quarter looks like. My sense is that as we get through the first quarter of next year, we're more likely to see the labor market data rolling over, and that's probably going to be a place where the Fed decides to stand pat and watch some softening in the labor market. There was certainly a conversation this week about the places you have seen the interest rate issues really take hold: the real estate sector, the consumer, not quite yet. Employment, at what point do you see it soften materially?
Yeah, probably not in the next few months, but I do think as we get into 2024, there's a good chance that the unemployment rate is starting to move up. Looking at the Fed's projections from the June meeting, which is a little bit dated now, but they had been anticipating the unemployment rate to rise from 3.5% to 4% by the end of this year and 4.5% by the end of next year. So it's less likely, I think, that 4% is attained in December. But if you take them at face value, and I think it's a reasonable base case, we're likely to see recessionary conditions next year. That's really the only way that you get a percentage point rise in unemployment.
We only have about a minute left here. Do you think that the recession comes to be that soft landing that the Fed is hoping for?
Well, look, Chair Powell said again today that they're looking to see some softening in labor market conditions and a little bit higher unemployment rate. The historical evidence suggests that we've never seen a rise in the unemployment rate of a 0.5 percentage point or more without a recession ensuing. And in every post-war economic cycle, the rise in the unemployment rate has always been at least 2 percentage points. So it's very hard to see. It would essentially be unprecedented for the Fed to nudge up the unemployment rate a little bit, run the economy a little bit below potential for a sustained period of time. A couple of years is what their forecasts suggest, and that not end in a recession. So I think a soft landing is looking unlikely.
Soft landing, but messy couple of years. We thank you so much, Brian Smedly of Cynosure. New job, by the way. Congrats. Still ahead, final spread. The week ahead, it's Jobs Day in America next week. And this is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg's Real Yield. It's time now for the final spread. The week ahead, coming up, JOLTS data coming out on Tuesday ahead of a reading of second quarter GDP on Wednesday. Thursday brings another round of jobless claims, plus the PCE deflator, and we will round out the week on Friday with the U.S. payrolls report, the big day ahead. Let's talk a little bit more about what that would look like. Non-farm payrolls expected to come in at 165,000. Unemployment rate standing steady at 3.5%. The participation rate also steady at 62.6%. And that average hourly earnings month over month expected to cool slightly at 3 basis points of 1% higher compared with 4 basis points or 0.4% the month earlier. And from New York, that does it for me. It's same time, same place next week. This was Bloomberg's Real Yield, and this is Bloomberg.